Our view is that for many months, if not longer, expectations in China were too low. Then very quickly they were reset and they were too high. And you see that in the volatility in the share prices, both mainland China and in Hong Kong and abroad. But our view remains that Chinese equities on a multi-year view remain cheap. We have allocated more capital to China this year than to any other market in Asia. We have allocated more to all the major markets, but to China most of all. And what we have seen is that the reason you've seen this violent share price move in recent weeks is because these shares were cheap. And then people are now discovering that through this period of weakening market sentiment and falling markets, Chinese companies have actually become much better. When we speak to them on a regular basis, we realize that a lot of the corporate value transformation that is underway in Japan and in South Korea and elsewhere in Asia has been under the radar, underway in China all along. And so we're finding a lot of great investment opportunities. Yeah. This is a welcome set of policy announcements. I know that Andy Rothman was highlighting what many others have said, is that the specifics are lacking, but it is a change in direction. The magnitude we'll see.
Does the market need a number? And we've been hearing of anything between 2 trillion to 10 trillion yuan. Are we going to get that from the MPC? Are they going to proverbially dot the I's and cross the T's on this fiscal stimulus program, which is where the policy priority needs to be? And is that what the market needs to really get some conviction?
I think that's what the market is hoping for and wants. What we have seen since last Tuesday, when the market reopened in mainland China, is that the specifics and the timing might be uncertain. But as you highlighted in the first question, we're on the right path now. So whether it's 2 trillion or 10 trillion, for us it doesn't make so much of a difference. Our bet on China is a multi-year bet. The Chinese equities are too low in valuation. Also, if you look at China's contribution to global GDP and then the contribution to global market cap, there's a huge disconnect. So whether you have 3% of your portfolio in China or 5 or 7, most likely it's too low today. It should be higher. And that's our argument. And then when you start doing your homework and you start meeting companies, you realize that you will find not just relative return opportunities, but absolute return opportunities also.
Because let me make sure I'm hearing you right. Are you saying you've got more money in China, invested in China, than you do in India, in Japan?
Relative to India, yes.
Yeah.
So we have multiple strategies. And if you look at our India strategy, where we're very constructive for the long term, we are fully deployed, zero cash. That has been the case for the last 2 years. And it has been very helpful. When you start looking around, many fund managers who are focused on India have 3, 5, 7, even 10% of their funds in cash. We have zero because we've seen a lot of opportunities. Any dip has been very, very short-lived in India. What have you not seen over the last 3 months in India? The election results, budget day, massive sell-offs across Asia, the rupee finally starting to weaken a little bit, but the market is not far from all-time highs. In the regional context, we are underweight India, overweight China. And so between the two at the start of the year, in our Pan-Asia strategies, we made a call that India is very exciting. There, in that strategy, we will be fully deployed. But relative to Chinese equities, we see a more compelling opportunity there.